Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to focus on one of the best dividend paying companies out there. This is a Dividend King. This company is one of the world's leading fast moving consumer goods companies. They have 65 brands. They serve over 5 billion people of over everywhere in the world. Every single continent that you go to, country you go to, you will find this company's product. They have branches in every single country that you can think of. This is very much one of the best companies out there. But before I get into the video, before I do any of that, as usual, please like the video, subscribe to the channel. Again, if you can join us on the Patreon, that will be absolutely amazing, where you get access to all of these things, including the Sharia compliant investing ebook. You get access to the private Discord, as well as all my buys and sells and the spreadsheets that I use. Now, the company that we're talking about today is Procter & Gamble. This is one of the, in my opinion, one of the best companies when it comes to dividend paying companies. Now, I'm going to go over their financials, but before I do that, I just want to talk about the company a little bit. As you can see here, the 2023, the net sales, okay, by business segment, as you can see, the fabric and home care was 35%, baby and feminine and family care was 25%, beauty 18%, health care 14%, and grooming was 8%. They are genuinely one of the best companies out there, because look at this, their portfolio 50% is in North America, but the rest of it is actually well diversified. Like I said earlier, you can find their products in every single country basically around the world, which is quite nice. Now, in terms of their financials, just the highlight from 2023, they basically got about 7+% organic sales growth, which is absolutely amazing. They have the core EPS, about 2% of core growth side of things. When we say organic, by the way, what we're talking about is the company is growing organically, meaning that they're not actually acquiring other businesses to grow their business, right? They're selling products that they normally make, okay, and they're growing it that way rather than basically acquiring other businesses and so on. And then years of paying dividends, 133 years of paying that dividend, and 65 years of increasing that dividend. So that's why I said this is probably one of the best companies out there when it comes to dividend. And they are returning more than $16 billion to shareholders, which is absolutely amazing, through by buying back their own shares as well as paying as dividends. Now, let's have a look at the financials. So right now, as you can see, is trading just over $150 per share. Is flat for the 1 year. So the last year, this company has done absolutely nothing. It has come down quite a bit. It was at some point $158 per share. Right now it's $150. If you know this company, there's not one of those high flying companies that goes up and down every single day, every single week. In terms of revenue, from 2014, it has $74 billion to right now $83 billion, which is absolutely amazing. When we look at the net income here, we're looking at about $11.6 to right now $11.6 billion US dollars to right now $15.2 billion. So that's also growing in the right direction. Now, when we look at this, the dividend side of it, so 2.5% is what you will get for every share of this company that you own. Basically, that the dividend yield, $355 billion. So it's actually a huge company. It's one of the mega companies out there. Now, looking at their payout ratio, it's slightly high. So we would like anything below 60%, 50% is actually quite nice. Like I said earlier, 133 years of paying that dividend. Latest increase was only 3%, which is a little bit disappointing, and 6% growth in the last 5 years, which is not bad. So on average, I've always said to you guys, 6%, 7% is absolutely decent. So the last 5 years, about 6%, not bad at all. And as you can see, they're gradually growing that dividend every single year for the last 65 years, non-stop. So without reduction, they've never cut their dividend for 133 years. Now, they pay you $3.76 for every share of this company that you own. And as you can see, these are the dividends that you will be getting if you were to buy. Now, the 5-year average is 2.4, let's call it 2.5, okay, percent. Right now, it's about the same. So if it looks like a fairly valued, that's why it looks reasonably valued. And the 5-year for PE side of things, the average is 2.24. Right now it's about 23, so it's slightly lower than where it was, and it has actually come down quite a bit because the PE was quite high not long ago. So in terms of earnings payout ratio and free cash flow payout ratio, it actually looks decent. So 70% we're looking for here, 70%, so it's below that number. Earnings per share, as you can see, is growing in the right direction. Free cash flow per share is also growing. In terms of shares outstanding, as you can see, they're buying back their own shares, which is quite nice because this is the type of companies that you want to own. Apart from that year where they actually decided to increase their dip basically here in 2020, probably something to do with the COVID situation, but they decided to issue more shares, but again they started buying back again. Total sales in terms of billions, as you can see, from 2014 about $74 billion to right now $83 billion. Return on equity, we're looking at about 33%, which is absolutely amazing. Normally, we're looking for about 15%. Return on invested capital, 22%. Operating margins of 24%. Free cash flow margin of 18%. Net income to EBITDA right now, we're looking for below 4 for these type of companies. For the consumer staples, but right now is 1.19. And going back now to Seeking Alpha, okay. Couple of more things in terms of earnings, so I'm going to show you what the analysts expecting. So going with the EPS first, so almost 8.5%, 7.4%, sorry 7.5, so 7.5%. If we focus on the first, maybe 4 or 5, so you can see about 8%, 7%, 7%, you know, 7% again, another 7%, which is quite nice. So this is the type of business that grows up there. Basically EPS about, let's say 3% to 5%, 7%, 10%, that sort of a range. So anything below 10% basically. And as you can see here in terms of revenue 2024, I think the year has already started, I think 2024. So they are expecting about $84 billion, let's call it $85 billion, then 88, then 91, then 96. So it's slightly growing about that 3% or 4% that we've already said. Now going to Yahoo Finance, as you can see, they're expecting this year about 7.8, and then next year, every single year for the next 5 years, they're expecting about that 7%, 8%. And this is what I expect from this type of company. And if you look at the average price here, okay, $165 per share. Right now it's about 160. As you can see there, the buys is about 4 buys, and basically strong buy is about 6 here. Looking at the Morningstar, I'm going to give you my own valuations. I'm going to combine all of them, and I'm going to give you some of my analysis in terms of the discounted cash flow model as well as the dividend discount model. So right now, as you can see, it's about 9% premium, if I can say the word. Fair valued price is $138 per share right now. And the company, of course, it has a wide economic moat. In the last 10 years, in the total return in the last years for this company is about, let's call it about 8% right now. Okay, according to Simply Dividend, Simply Wall Street, sorry, $198 per share is where they think the price should be. That's about 24% basic discount from where we are now. If you look at their growth, about 5-6%, 6%, which is quite nice right now. Now let's have a look at the valuation. So we're looking at what Morningstar said. We're looking at what Simply Wall Street have said. We're looking at Seeking Alpha as well as my discounted cash flow model and the dividend discount model. So the dividend discount model basically is, I've included that today. So that gives us about $164 per share right now. That's basically the price on the average intrinsic value of this company, currently trading about 150. Difference is about 9%. So now if you were to buy this company and you think, you know what, this is one of those companies that's kind of okay-ish business, I don't really see any huge problems coming our way in the next whatever years, then you give yourself about 5%. That will still be a buy. Now if you want a little bit more than that, you think it's really expensive, and you're just going to give yourself about 15% margin of safety, which is really reasonable because that's only $10 from where we are now. So the buy price will be about 150, 140. So you could potentially add it to your watch list and leave it there, and when it hits that price, then you can of course do your own research. Again, please don't just take this for what just take it for what it is, and don't basically use this as a, of course, advice that you need to buy this stock at this price. Okay, again, it depends on you. You might want a 20%, you might want a 15%. In my opinion, right now the company, I am not adding to it yet. Okay, so I'll show you how many shares of this company I own before I stop the video. Let's have a look. There you go. I've got about 35 shares, or 34 and a half shares right now, over just £4,000. I'm up about 6%. I have actually bought a little bit here and there. So I basically, my price was 145. I was expecting it to come down a little bit, and if it hits 145, that's about $5 from where it is right now. If it hits that price, then I will buy more, because my average price is 141. So if it comes down and I get that opportunity, inshallah, in the next few weeks, I will be adding a bit more. I want to get to at least 40 to 50 shares of this company. I really like the business model. Again, it's one of those companies, they're everywhere around the world. Some people will say, oh, there's a negative thing about, because they have a branch in here and there, but right now they have branches every single place in this world. Okay, so it's basically, and every single company we talk about has branches everywhere around the world, so we can't just hold that against it unless we have absolute concrete evidence to say they do support certain countries. But yeah, I just wanted to share with you guys this today. And if you like this type of content, you of course enjoying what we're doing here, transparency and everything else, please join us on the Patreon account. Please like the video, subscribe to the channel. It makes a huge difference to me, and of course it gets me going, inshallah, and we will grow at this channel hopefully to help a lot more brothers and sisters out there. Have a wonderful day. Assalamu Alaikum.